Hello, hello. Good afternoon to you as well. Good afternoon. Okay, so who do we have? Got Rose, Rameshi, and Sam. Yeah, I opened the bridge a minute earlier, so we'll give some time for others to join. Meanwhile, hopefully I can finish my coffee. So what's on your mind? Regulars, yeah. Uh, pretty re
I,
and I thank you guys for being regular. So what else? Uh, so we also have Freddy. We have Fred. Sam, I missed out on CRM. I'm not sure, Sam, what you say missed out. So CRM is still, I mean, it, it after the initial drop, it came back on Friday, but I guess if you're really interested in it, there's still time to pick CRM. I don't think you missed the boat though. CRM. So we will talk a little bit about CRM. Gosh, if you let me share my screen. Damn, that was a one big huge drop on CRM. It from
excuse me. I think I got into CRM because of you, and then other people were commenting on it. And I thought, well, if you talk about it, there must be something there. Because I think all U.S. stocks are overpriced. Uh, well, most popular U.S. stocks are overpriced.
yeah, because they're popular. Uh, So the crowd will bid up its price. It's a at the end of the day, the stock market is an auction mechanism, right? Someone will say $100, someone will, if stock is popular, someone will say $101, right? So in a short term, so we will, and many of these SaaS popular software stocks got beaten up this week after their earnings. We'll look at MongoDB. We will look at Salesforce. I'll probably pick up just one comment, and this is what's surprising, right? It's a just one question shaves off billions of dollars on a company. That's what happened with Dell. So we're gonna look at that. We're gonna finish our hims and hers review that we were doing, stock research. So we're gonna finish that today. And what else? I read something about JEPI. I know a lot of folks, retail investors, are interested in JEPI. So we're gonna talk a little bit about that. Um, yeah, I think that's those are the things on my pipeline. Anything else you want to talk about? Any other stock?
Well, WeWork, it went down. I think I got it when it was going down, but it's coming back up, so it's not popular. But I don't know what the guy's doing, but generating news again.
So WeWork is more of you're trying to play the bank. Okay, so now I don't even think whether this guy has what's the ticker of WeWork? I remember I only did again a lottery ticket in WeWork. Once in a while, you like to just gamble, and I think that's once I did a lottery ticket on WeWork because I think the stock went down because of a bankruptcy concerns, and then I just bought it and then I just sold it when it doubled. Very small position because that's a lottery ticket, but I haven't looked at there. So now it's emerging back from bankruptcy, emerges from bankruptcy. Yeah. So not a stock that I would like hold for a long time or would be interested in. It's just it's a gamble they're trying to do, right? Meme stocks or those meme coins, or maybe play with WeWork, but not something that I would want to own for a long term, just because I'm still not comfortable with their business model of getting into long-term liabilities and trying to finance it with the short-term assets, right? Just doesn't work out. So I see a comment. I'm holding CRM for long term. A lab. Which is A lab? I heard of R lab. Which is A lab stock?
Arista.
No, Arista is not A lab. Or Astera Labs. Uh, Arista ticker I'm familiar with. Astera Labs. What does it do? Uh, must be a biotech or something. Don't know. A lab. Manufactures, oh, semiconductor based connectivity solution for cloud and AI infrastructure. So, all right. So it's riding the cloud wave. Oh, sorry, riding the AI wave. It's a new IPO, looks like. Came IPO in April, went almost nowhere, back to where it's, after day one. Mm, let me first see whether it's how big this company is. Okay, 115 million. Let's look at a quarterly. I don't have much information, at least here. A pretty small one, 115 million of revenue. Okay, let me see if this has Astera Labs. $10 billion market cap on 163 million of revenue. Yeah, something that clearly not okay, absolutely no income. And so they're basically losing 100 million on a revenue of 163 million. Not a profile that I would be interested in. Now let's look at and again, this is like, I'm just giving a 2 minutes overview. So 163, 100 million loss on even on operating income. So clearly they are spending a lot more than what they are making. 163 million last 12 months in revenue and spent 200 plus million in sales and G&A. So it's like you are selling everything at a discount. So you get a revenue, but then you book that discount as your marketing expense. I'm not interested. Too smaller revenue. Yeah, stock could go anywhere. I mean, this is not a profile that I'll be interested in. There are much better companies available in the market uh, to put my money behind. I'm not looking for these uh, trying to wait and maybe if the crowd pushes it out and try to get out of this. No, I'm not interested. I know it's got an AI name behind it. That's why probably even the stock hasn't done that great. Looks like the first maybe trade happened at 50, then it's back down to 60. So no, I would rather give it and it's pretty new, so we don't even know how it would behave. I'll at least wait for 2 to 3 quarters for it to show me its performance before I want to put my money behind it. Looking at it right now, I'm definitely not interested. No operating margins. Forget profit. I'm not even looking at net profit margins. Can't even operate the company profitably. And how much is the revenue growth? Are they growing like crazy? 1230, it was 79 million in 2022. and then 115 million in 2023. Not, it's a good growth, but not the way they are spending. So nope. Again, I have no idea about what this company does, but the financial profile itself doesn't look interesting enough for me to even dig down into it. Nvidia, Intel, AMD are some of the companies that use ALAB. So I think that's the reason why maybe it's the stock has been bid up, but clearly I want to give it more time to prove itself worthy of my dollars. Arista Network. Arista, I think we have looked at Arista even earlier also. And that time the big concern was their customer concentration. But otherwise, I think the company was fine from a profile perspective. It's a company that does, you know, you can add and keep it in your portfolio, right? So, but so it's not that I'm gonna reject it at the first look. My only biggest concern was around their customer concentration at that point of a time. I don't know how much where they are on their customer concentration, because earlier I think Meta was one of their biggest customers, and when Meta sneezed, Arista it gets fever. So other than that, I think the company, so I can look at $2 billion sales, sorry, sales of $6 billion, of net income of $2 billion, which is good. That's really good. It's like 33% net profit margin. And I'm looking at operating profit margin 40% for a hardware company. This is pretty good number. So, and they are, where's their sales growth quarter on quarter? Yeah, and they are growing nicely. So yeah, now from a valuation perspective, it is pretty expensive right now. Right. So again, the question is, they can continue to grow their revenue. Will it grow into the valuation? Maybe, but I think this is also enjoying the tailwinds of AI player, low network latency, usage in data center. So all companies related to data center, AI, semiconductor chips, they're enjoying the tailwind of from AI. But yeah, this is a company. Yeah, it will be interested in digging deeper and see if you want to add it or not. It is expensive. Looking at it's currently trading at what, 41 of PE. Even forward PE is 33. So profile is good. I mean, no debt and decent cash on the balance sheet. So $17 cash. Yeah, not that I would reject it in the first glance. CRSP is getting to my purchase around 40. So are people bored? CRSP, what? CRISPR? CRISPR Therapeutics? Right? Like it's above 40. It's now 54. This is one stock which I have not been
It's going back down. That's what I'm saying. It's going back down. I mean, look, it went up to 7. It went up
to 90.
Yeah, I got it right when it was at 40, 41 last time.
So I don't see it around anywhere around 41. 41 will be, I mean, 41 was here, like say in November.
Yeah, I just place these trades in case I could catch these things really cheap.
So I don't know why this stock hasn't performed, even though
it's not profitable.
no, not profitable, but FDA had approved usage of gene editing for one of the treatments, and I thought maybe after that, CRISPR Therapeutics should have a decent run up, but I didn't see that. And again, I've not looked into this company, but yeah, $271 million of sales, which is pretty small. So to me, for me, it looks like the play gonna be on this one is that some one of the big pharma or these meta companies might just buy it out, right? But that's many of these companies will do, that they'll have these smaller companies, either the biotech or the ones which are basically investing and doing a proof of concept, make sure that you get all the way through approval. They spend all the money in R&D, and then the bigger company will just buy them out. We've seen in time and time again happening in biotech and in the pharma companies. So that could be a play. But yeah, again, I've not looked into this. I don't know how big uh, sales team they have to go and sell it, but if it becomes a part of a much bigger company, then once the tech is proven, once the tech is approved, then bigger company, it becomes very attractive for a bigger company to just buy these out.
There's four companies that use this technology, and one of them is getting ahead. I'm sorry, I don't know the name of it, but one of them is really profitable.
Yeah,
Sorry, I don't know the name of it.
no worries. Google AlphaFold 3 is killing it. Yeah, so we talked about it. So AlphaFold, was it 3, right? That they are able to uh, map out all the molecules. There is when I read about it, there were like 3 different type of thingies that exist in our body, and now they're able to basically map out all 3 of them. Earlier, I think they were only able to do one, either proteins or DNA. Oh yeah, there are ligands, DNA, RNA, proteins. So I think we did talk about it, and when we were looking at a Google and say, hey, there could be this in itself, isomorphic lab in itself could be, if they could commercialize it, actually could be another $100 billion business sitting inside Google. Right? And I can't recall now which weekly discussion we thought. Maybe I think it was after Google I/O. So yeah. But right now, it is within a part of a bigger Google ecosystem, just like we got a Waymo. So there are 2 businesses, the bets on Google, which looks pretty interesting. Could become a big $1 billion businesses, just like YouTube has become, isomorphic as well as Waymo.
Uh, Vivek,
Yeah.
the C oh no, sorry, yeah, the CEO of Microsoft left the Starbucks. I thought he left Starbucks board because he wanted to focus on Microsoft and realized Starbucks isn't of any use. But what the news reported was because the CEO, chairman of Microsoft, says the company's okay. He doesn't have to look at it any longer. What do you
Oh,
think?
so I have heard. So he was on the board of Starbucks.
Yeah, he left. He just left it, but like I thought, he's focusing more on Microsoft and realized Starbucks is of no use to him. But
No,
the media reported
I,
that he thinks he gives the okay to the current Indian CEO of Starbucks.
no, I won't read much into it. The boards, the amount the role that board play, especially nowadays, has become very less, and I won't read much into it. Him being on the board or not. So yes, Starbucks hasn't been doing good. I think a lot of people who are dividend players own Starbucks because it used to give a handsome dividend. Dividend yield right now is, where's the Starbucks dividend yield? 2.7, almost 3% dividend yield. But it hasn't been performing. Starbucks. Uh, Again, I don't know. So Starbucks CEO came and told that the customers are because of inflation and all that stuff, customers are not spending much. We heard the same thing from McDonald's. That's why they're bringing back that $5 um, whatever meal, etc. But let's see what the new CEO can do. I wouldn't be surprised if they bring back Howard Schultz. But that's gonna reveal another weakness in Starbucks is, gosh, they don't have a really good succession plan. We've seen that in Disney, where Bob Iger, I don't know, this is what his third inning or something, and he's back. I don't know who will succeed Bob Iger in Disney, but similarly on Starbucks, Howard Schultz has already done a U-turn, I guess, once. Don't quote me on that, but and then they brought in Lakshman. Let's see what he can do, or how long can Lakshman stay in this hot seat. Definitely, if the stock is not going to perform, I don't know how much patience the board will have with him. But I don't own Starbucks, so but it hasn't been performing for almost, I would say, maybe 2 years or something. I think during COVID it was close to 150. Now let's go back to weekly. Yeah, so not 150, maybe 120-ish or something. Yeah. And since then it was in range bound, but now recently had a huge drop. All right. Okay, so let's start with today's discussion, guys. Unless there is anything else. Cool. I don't MCD rose 40 prices 40%. I don't know if they still have a pricing power, but forget MCD. I think a lot of these, even Chipotle, all the staples companies rose their prices during COVID, including I think it was Target as well. And one of the CEO in fact made a comment saying we the sales volume has not increased, but our sales revenue has increased by 8%. All that 8% came from increase in pricing. I think maybe it was Target. Not sure, but one of those retail companies CEO had made that statement. All right, so looks like we got a decent crowd. Let me see. Anyone joining here for the first time? Any first timers? Yeah.
Yes, this is my first time.
Hey Cody, what brings you here? What are you looking to get out from this session?
Just kind of figure out what the group's about and just kind of learn more about finance and the market itself. So just kind of probing, seeing what's out there.
Cool. All right. So yeah, so again, this is for the benefit for all of us. I do bring up some content that I observe in a week and talk about it. Companies or the less on the macro, more on the companies, market structure, investing, uh, whether it's stock or bonds or crypto. I don't get into the details of it, crypto though. So and yeah, have any questions? Pitch in, and hope it will be useful for you.
Yeah, thank you for having me.
Oh, welcome. Erika says first time here. Welcome, Erika. Checking it out. Very new learner. So oh God, I know earlier someone had asked me, but I don't recall someone asked around some of the beginner investing sessions that I covered. I looked into it, but then I forgot who asked, so I didn't email because I didn't receive that email. So whoever had asked earlier, I think it was 2 sessions ago, on the sessions in which I'd covered about how do you start if you're a very beginner investor. It was in session 192 and I think 193. So look into the recording of those 2 sessions. In those I covered, very beginner on starting your investing journey. Okay. All right, so let's get into today's session. We're going to talk about a little bit of an earnings, and then we'll finish our pending work from last week, which was we were looking at a stock, Hims and Hers, and I had an internet issue, and then the meeting ended abruptly. Apologies for that, but we're going to finish that work today. I'm going to talk about JEPI. I learned something about JEPI this week, which is JP Morgan Equity Premium Income ETF, one of a big ETF. There was a change in the market this week. T+1, we moved from T+2 settlement to T+2 settlement to T+1. Gonna review that. Do a portfolio review. This is the first meeting of a new month, and every time when we have a first meeting of a new month, I do share my top 10, 15 holdings. Yeah, that's on a high level an agenda for today. Okay. So let's finish our stock from scratch, Hims and Hers, and see if then you can decide whether you want to invest in this or not. Okay. So where were we? We were doing or evaluate scoring of Hims or Hers on various aspects. So let me bring back that scorecard. So this is where we were. I think I was trying to get to the glass door and suddenly realized my internet wasn't working. So we're gonna look at employee rating on Hims on Hers. Let's say Hims glass door, Hims and Hers. See what's the CEO. Okay. Not that great. Revenue. Okay. Employer rating 4, between 3.4 and 4, then 0. So this is going to be, it's below 3.5 overall. So it's going to be -1. Founder, if founder is still involved, because founder-led companies continue to outperform. If you go back and look at some of the statistics and studies, the founder-led companies generally tend to outperform the professionally hired CEO-led companies. So I do want to give a more high rating to a company which are still led by founders. So who founded Hims and Hers? I think Freddie, you brought up this talk. So who was the founder of Hims and Hers? Hers founder, Andrew Durham. Andrew Durham. So he is still the CEO. So then I will give him full 1 point for that one. Management ownership, negative. Okay, so let's look at management ownership. That should be part of an annual report. So let's bring that up. 2023 annual report. Okay, so security ownership, the information will be in 2024 proxy statement. Okay, so we need to go to the proxy statement. And I'm doing this because I think some of you have asked me earlier, how do you analyze the stock? So we're going through the whole process. We did half of it last week, now finishing the rest half of it. Hims and Hers, investor relation. Now I need a proxy statement, which I don't have. I downloaded the annual report, but now I need a proxy statement because they haven't provided the ownership information in the annual report. So we're going to download this proxy statement. And here we should be able to see who owns how much. There we go. So directors, that's a director's compensation. So he's still the CEO. All right. Where is ownership information, security ownership. There we go. So he the one thing about I don't like here is they didn't mention the role of these people. I know Yemi Okupe, he is CFO, he is a CEO. Who is Melissa? What's her role in the company? She's a COO. Okay. So I would still say I think this is a decent enough management skin in the game, 10%. So let's go back here and see management ownership, 8% plus, plus one is more than 8%. Okay, risk. Now let's look at the risk factor. So for those who are joining for the first time, we we looked at the company's mission statement, see if it has a moat or not, and rated it accordingly. Looked at the optionality, can they grow into adjacent businesses or entirely new businesses? Looked at the financial health. Now we looked at the soft factors. Now I'm looking at the risk profile. Customer concentration risk. Does it have a customer concentration risk? Yay, nay. Customer concentration risk means very few number of our customers actually account for majority of our revenue. So if one customer moves out, you're going to have a tough time. We've seen that happen with Twilio, I think maybe 5 years ago, when Uber decided to build their whole SMS communication system in-house. Twilio dropped by 40% on a day. We saw that happening with Arista Labs because Meta was one of the big customer and Meta coughed, Arista got fever. Does Hims and Hers have a customer concentration risk? Come on. Fred, what do you think? This is your stock. So I want to poke you because I want you guys to think, right? I want to teach how to fish. So it does not have. Yeah, Aditya says no. Yeah, it does not have because it's selling it products to millions and whatever 2 million customers it has. So it's selling products to them. So no customer concentration. Is it dependent on the kindness of others? So this is where I want to look at three things. One is their operating income. And we already looked at their operating margin and we already dinged them for operating margin because it doesn't make any operating income. So now let's look at do they have a high debt to equity ratio? Are they raising more debt or are they diluting the shareholders because they need money to operate? So they can't generate dollars from or they can't generate the money through the business. Then the only two other options are either borrow or sell your equity. Right? So we're going to look at the stock dilution and or we see if it is what's his debt to equity ratio is. So let's go back to sorry, where's my let's go to Hims and Hers. Let's look at its financials. Let's look at its ratios. Debt to equity almost nil, which is great. So they don't have a debt. But how about dilution? So they have been diluting shareholders. In recent time, they diluted almost 10%. So obviously, then they are raising money by diluting the shareholder. So not good. So they're still, I'll say -1. Industry disruption. Could the industry in which Hims and Her operates, could that be disrupted? So Hims and Hers, as we look at it's into telehealth plus other adjacent areas, dermatology, sexual health, mental health, weight loss. Could it be disrupted? My opinion, I think industry is ripe for disruption because there are many players in this same segment. But I think Hims and Hers is again one of those players. So this is an ongoing, ongoing disruption in this particular industry. So I'm not going to give negative, I will say 0. Outside forces, commodity prices, interest rate, stock price, strong economy, does it get impacted by it? What kind of, so products that it sells are related to health, which generally, which are, I would say, resistant to uh, macroeconomy, because you still need to take care of your health. But let me see what we looked into the annual report, what kind of a product itself. Are those more discretionary products? So let's go back to their website and see, are those more discretionary products or those essential products? What do you think? Discretionary, essential? Now, based on that, we could give a rating saying, would it be impacted by or not? For now, I don't want to ding it. Extreme dilution, did they diluted annual share count growth more than 5%? Yes, it is. But it's a small, young growing company. And in that case, I would, okay, say -1. Revenue growth by acquisition only. I didn't see a lot of acquisition. I think there was only one acquisition that we looked at when we looked at its annual statement. The other way to find out if there were acquisitions is maybe look at their balance sheet, and then we see if, oops, where's the balance sheet? If they have a lot of a goodwill on their balance sheet or not. So assets. Oh, come on. Where's the financial statements and supplementary data, consolidated balance sheets? There we go. I don't see any, they do have $110 million of goodwill. Oh, sorry. Yeah, $110 million of goodwill. So they did acquire one company. I think it was mentioned in the related transactions, but beyond that, there wasn't much. So it is having its organic growth. Management misfits. Again, I've not looked into the company, but I didn't see when I was searching for hims and hers, the first thing that popped up on a Google was, and oh, management has done this gotcha, right? So I would give it a benefit of doubt. Geopolitical risks, I don't think. It's in US, it's not in a unfriendly country. Currency risk, not much, because most of the revenue is driven from US and not from outside of the US. Almost no currency risk. High exit turnover, that we should be able to figure out if we look into the proxies. Where was that proxy statement? It should tell. So CEO has been around. The founder and CEO has been around for long. Let me see. So CFO has joined in Jan 2022. This company was founded in maybe around 2016. COO since 2018. CLO 2018. Chief Commercial Officer 21. Yeah, so I don't think there's a huge executive turnover. Yeah. What does that bring me to? Okay. So this is what it is. Right. Again, we spent whatever 30 minutes last week. So this is not I would say, a thorough analysis. But based on what we know so far about this company, I'm not interested in this. Right? I'm not interested in this. I mean, my thesis is, if below 10, don't waste your time on it. So share price probably has grown a lot. Now, this is where you need to look at your own judgment and see, maybe now let me look at its latest quarterly report and see how its growth has been, what the product itself, because this is all looking at history, right? These all financial numbers, these all are history. But is it possible that the market is excited about something which is in future? Maybe. And I know Hims and Hers, they recently announced that they will be able to offer weight loss drug, the GLP-1 drug, at what, $199, something like that. Hims and Hers GLP-1, Hims and Hers GLP. They announced GLP-1 injections medication at very, because the one which is from Novartis and Eli Lilly cost almost $1,000 per month. And I think they announced that they'll be able to do it maybe 200 or something like that. Did that get market excited? Maybe possible. But other than that, the profile doesn't look that great for me to get excited about this company, irrespective of whatever the share might have done. So at this point of time, I'm gonna maybe, spend some more time to see what the future could be, look at its latest quarterly report and see what their projections are. Will that change my mind? Possibly, but the score is too less. So for me, not investable. All right. Any questions on Hims and Hers before we call it done? Yeah, they were selling at $200. Cool. Ramesh just said, agree, can invest in other established stocks. Yep. Does that mean that one of the stocks could become, a multi-bagger 10 years down the line and we miss it? Maybe, possible, but I don't want to right now, based on what I know of Hims and Hers, right now, doesn't seem to be interested to me. If it was around 6, 7, I would have spent more time. Cool. So that's done. Oh, by the way, maybe next week I'll spend some time on this whole GLP stuff. I'm still going through trying to understand this space on what's happened. I like really Novartis, and how is it that they are able to offer $199 a month, where others are not, because currently it is at a shortage list. The moment GLP-1 drug moves off from the shortage list of FDA, they will legally be not able to manufacture these drugs and sell it at such a low price. So if this is what have got you excited, then that's just a matter of time. It is not exactly the same drug. This is something called a compounding, not the financial compounding, but Hims on Hers or any other pharmacy, they can work with the compounding labs, which will take the same molecules or the same ingredients as it is in Wegovy, or is it in Zepbound, or is it in Mounjaro, or it is in Ozempic, and they will mix it in the same proportion. This is the like compounding pharmacy, and that's assumption that it will have a similar effect as Ozempic would have, or the other FDA approved drugs would have. So FDA does come up with a short list if the pharma companies who own the patent on these drugs are not able to produce it in enough quantity, then FDA moves or adds these drugs into a shortage list. And once you've added into a shortage list, then legally you can actually create a similar drug using the same basic compounds. You're not violating the IP of it, right? Otherwise, you can't. So, but if it moves off the shortage list, then you can't do it. So right now, this drug is in a shortage list. So I think that it does say that it has the same active ingredient, but it hasn't gone through the same trials, uh, which let's say Ozempic would have gone through. So gotta be careful in terms of how many people would. I guess it's so cheap that people will take it anyway, right? I don't care. It's a generic stuff. It's got the same active ingredients. I'll take it, but I don't know how long will this tail stay on this. Okay. So that's on him on hers. All right. Let's get back to our regular schedule. This was our pending work from last week. Dollar store by 99 cent stores. Okay. Dollar store, I don't know which dollar store, Dollar Tree or Dollar General. What's happening in the market? Yeah, I would still say I think we are still doing good for May. Oh, sell in May, go away hasn't so far. That seems to be, not great. But of course, we had. I think this week we had. Friday was a big reversal. I think we started in red, and last 1 hour or something, market suddenly had some decent amount of recovery. But who cares what happens in a week? On the big side, so Nvidia continues to go higher. So Nvidia splitting 1:10 split. When is it? Was it June 1st or June 6th? Nvidia split date June 10th. Okay, so I guess those who want to take advantage of the split maybe still buying up Nvidia, and it was up for another 5.62%. I think this could be a standard statement. We can make Nvidia up another few percent, seeing it week after week. Yeah, nothing much that stood out. Of course, some of the stocks that reported earnings, and any small crack in the earnings, stock really got punished. Really punished badly. So that tells us how much of the expectations is already priced into these stocks. Sector-wise, communication service is still on the top. Year to date, S&P's returned 9.76%, which is pretty good. And yeah, there's nothing to complain about. At 9.76%, we are barely halfway. Fear and greed index, last week it was 53, and now back to neutral. VIX is still low, and I'm surprised how, given all the stuff that we are seeing, how come VIX is still trading at below 13? VIX is still below 13. It had a huge candle on Friday, because we started Friday in red, and then by the end of a Friday, markets turned green. So VIX is below 13, which I'm a little surprised, but who cares? Crypto market side, only once, I think Semler Scientific, I read that now they are also taking a leaf out of MicroStrategy and have decided to buy Bitcoin as a treasury, as a part of their treasury operations to hold Bitcoin on their balance sheet. I think they bought some 40 million worth of Bitcoin. Not a big amount, but I think it's a narrative that matters more in this space than the real numbers. From narrative perspective, yeah, companies now, especially after the ETF approval, now are warming up to the fact that, gosh, this is an asset class. Just like real estate became an asset class, gold became an asset class decades ago. This is another asset class. So Semler Scientific, they are basically a medical tech devices, and and have a device which measures your blood flow and then will tell you about some diseases. I I read about this company a few years ago. I've not don't follow it anymore, except the fact that this popped up saying, hey, there is another company that is now decided to put Bitcoin on their balance sheet. So what they have to say is Bitcoin is now an asset class with more than $1 trillion market value. It is growing global acceptance and institutionalization, which is basically ETF approval. So after studying various alternatives, we decided that holding Bitcoin would be the best use of our excess cash. This seems just like Michael Saylor. I don't know if he would have orange pilled Mr. Samler, but it looks that to be the case. So let's look at what are the other companies that are holding Bitcoin on their balance sheet. So of course, MicroStrategy is on the top, has but 214,000. Marathon Digital, this is a minor, so I'll ignore it. It's a part of their operations, not really a treasury, but as a part of their ongoing business. Tesla is still holding. I don't think Tesla ever sold their holdings of Bitcoin. Tesla first bought 2021, I guess, and they never sold. Hut 8 is mining. Coinbase is not mining, but they are an exchange. So Right is mining. Galaxy Digital is in a Bitcoin. So Block is another one. They had added Bitcoin again 2020, 2021. And now they've also told that the 10% of their gross profits from their crypto operations, they'll buy Bitcoin. CleanSpark is mining. No, this is Bitcoin Group. Now we are moving on to Europe. Yes, I'm looking at something which is non-crypto company. Meichu, this is Hong Kong. Again, this is pretty old holdings. Yeah, Semler Scientific, they bought it this week. Mercado Libre owns a little bit of it. They do have this allow the customers to buy and sell cryptos. I guess it's because of that. Metromile, what do they have to do it? What does Metromile want to own Bitcoin? This is an insurance company. Well, I didn't know about that until today. 6 months ended June, the company purchased $1 million solely of Bitcoin. Okay, so they spent $1 million in buying Bitcoin, so which is now $1.7 million. Decent return in 3 years, I guess. Okay, all right. Not to, like I said, it's more from a narrative perspective than anything else. Other thing which came, I think, at the end of day Friday, and I didn't update it, was Joe Biden, the president. He vetoed the bill which was repealing SAB 121. Go figure. Okay, so we're back to fighting the war with the current administration. So on Friday, late Friday, there was a update from White House that they vetoed the bill. I don't know what exactly the process of reintroducing the bill, but that's where we stand. So that means your banks and the regulated, especially the banks, they cannot get into the business of custody of Bitcoins or any digital assets, not just a Bitcoin, but any digital assets. And they'll have to see, BlackRocks and other Coinbase, etc., make money by custodying it. They can do it. So a quick look at market. That didn't impact the market much. I mean, it's been the range bound between, I would say it's been trading between 65 and 70 or 71 for almost a few weeks. Ethereum, after the initial bump after on ETH approval, now is trading between, the same stuff, 3,500 and 3,900. Yeah, not big change. So looks like the market has taken in its stride the veto stuff. So we'll see. US government holds 210. Yeah, so US government has the ones which they have confiscated from various criminals, but this list is from a publicly traded companies. There is a separate list which will be, I don't know if this website has that. Europe, governments or all other holders. But yes, US government has got a lot of Bitcoins. Oh, there will be, right? It's countries. Which countries? USA has got $207,000 Bitcoin. China is the number 2. Yeah. Cool. So that's on a quick update on crypto. Questions? Anyone swinging on crypto memes? I don't do that. Another news was looks like PayPal, they want to now offer the stable coin on Solana, because Solana is a favorite chain for a lot of crypto meme crowd, and a lot of activity happening over there. So PayPal announced that they will have their PayUSD also available on Solana. So no questions, what did I buy or sell? I bought Shop. We talked about it during our boot camp. Saying I was assigned a short put on Shop last week. It was a June expiration, so still have more than 3 weeks to go. Generally, all your assignments will happen in the last week or 2 weeks, but we covered in drill number 5 on how to find a risk of early assignment, and that's the case. The extrinsic value was like 2 or 3 cents, right? So not a surprise if you get assigned, because there is nothing more extrinsic value left. And these are the cases when you could actually get assigned 3.5 weeks before expiration. Other than that, so I'm still holding it. I would see if I want to hold all the 100 shares or not. Right now, I'm still holding all the 100 shares in the portfolio that got assigned. Okay. And I sold a little bit of SE. Nothing, I've not changed my outlook towards this company, C Limited, but just that because I got assigned, I wanted to raise a little bit of more of cash. So I bought small portion, I don't know, maybe last year at much cheaper price than where it is trading today. I trimmed a little bit of it. Those are the only 2 movements on the stocks that I've done. Okay. So let's look at the current portfolio, then we'll come back to a little bit of earnings. So based on all that, how do I look at the end of May? This is what the top 15 positions are. We'll give you a minute to look at it. If you have any questions, feel free to ping me. So I don't think anything has changed except the NVIDIA and Berkshire Hathaway have traded places. So NVIDIA has moved up from number 14 to number 13. I think that's the only change that has happened. And no surprises, as NVIDIA is like hitting new all-time high every week. So yeah, that's where we are. Okay, cool. Again, this is not a recommendation, but because we talk about a lot of stocks, I just want to be open and transparent on what I hold in my portfolio. So if you see, yeah, I got Shopify, but yeah, it's number 15 position right now. But I'm bullish on it, but it's number 15 position. Cool. All right, let's look at some of the earnings and see what happened. Dell. I tweeted about it. One question that killed the stock. So if you look at Dell, it's a horrible, I mean, they had for almost from 180 to 120, 130, $50. Huge move, a huge post-earning moves on Dell. And just one question that killed was this. So Tony from Bernstein asked the question. I'll just go through the question. The answer is very convoluted without actually answering what Tony was asking for, which was, yeah, thank you for the question. If I just look year over year at the ISG business, storage was perfectly flat. AI servers went from 0 to $101.7 billion. Not surprised. which sort of suggests that traditional servers were flat. So really the only thing that you changed was that you added $1.7 billion in AI servers. That's the only increase in your revenue. But your profit was still flat. Does that suggest that the operating margins of AI server were effectively zero? And if that's not the case, how do you square the circle with what I just outlined? Thank you. Yeah, yeah. CFO didn't answer it really, but only one line, which I think where she considered that those AI optimized servers we talked about are being margin rate diluted, but margin dollar accretive. Means more AI servers you sell, bad will be your margin profile. Now you take whatever you want to. If you are an investor, do you want a better return on investment? So what they are saying is, I'll have a better dollar. We made more operating income. And I don't know did they make or not, but if you have to read this, margin dollar equity means we made more income, but less, margin when it comes to percentage wise. So it means or at least in this particular quarter, whatever AI servers they sold didn't really help them to increase their margins. Now, the question that I have is, if AI and AI optimized servers, and if it is so hot, why are they not being able to charge, more for their servers? Or we should even look at that, maybe able to increase their margins like it has done for NVIDIA. NVIDIA can, get an operating margin profile of 50-60% because they got a chips that everyone want. Anyway, NVIDIA can charge them whatever NVIDIA wants to. I'm not saying that that's going to continue to be the case forever for NVIDIA. Obviously won't be. But now I'm thinking, if there is so much of hype around AI, AI PCs, Microsoft is talking about, Dell is talking about AI optimized servers. But gosh, if you have to sell it at the same at like zero operating margins, then what's the point? I'm increasing my revenue, but I'm not making the money on it. So really, that tells us that Dell, the whole AI tailwind, Dell is not able to take advantage of it. So again, that was a question that killed the stock. I haven't gone through the overall earnings, but I guess this is telling something, that having AI servers doesn't mean that you're going to be able to reap the benefits. Other one, let's look at MongoDB. Again, MongoDB also had a bad stock reaction after earnings. So what happened with MongoDB? They actually beat estimate. This is great, but the growth has slowed down meaningfully. What is looking at a growth? So they grew 22.34% in this quarter, which is lowest growth in its public market history. So it is still growing. Don't get me wrong, that it's not stagnating or the revenue is not declining. Revenue is still growing, but grew at the slowest pace in the history of the company. Number two, the guidance for both the next quarter as well as the full year was underwhelming. So you have a slowest growth, and then your guidance is lower than what the street is expecting. So that's like not good, right? And on top of it, they never made money. So looking at last 5 years of its margin profile, never had even a single quarter where they were able to operate the business profitably. So you could always, so these are some of those darlings of, I would say, 2018, 2019 free money, where a lot of these companies came around, build one product, capture, increase your revenue, but even after now almost 5 years, can't make an operating profit. So which should tell us something about it. So let's look at MDB and see what's there. And I don't own it. So if you look at year-to-year basis, even on year-to-year basis, they're growing at what, 30%, 46%. And now if I look at their operating margins, pretty bad. But you could have your rule of 40, which is, they generally apply to high growth companies. VCs will apply the rule of 40, which means, hey, if you're growing your revenue like gangbusters and you're not making, margins, fine, as long as you stick to rule of 40, which means your sum total of your revenue growth plus your operating margin. Some people will like to take it to as a free cash flow margin. I've seen a multiple variations of rule of 40. I think it's a different when the VC in the public market is, but let's say it's your operating margin plus your revenue growth, right? If you're growing gangbusters and not making money, yeah, I'll be patient. In this case, growing at 31% and with the operating margin negative 14%, nowhere near sum total is not 40. Like you are now looking at what, 15, 46, 27. So it also clearly it fails even the rule of 40. I mean, I would even be cautious even if some company passes the rule of 40, but are still, not making operating margin. But MongoDB, it doesn't even pass my litmus test of, rule of 40. So not interested. I think the stock has been at multiple places though in its lifetime. Let's see, we can, wow. At some point of time, it was almost $600. So I'm not surprised that, once this whole zero interest rate environment has gone, now the investors are looking at profitability. Right? At some point of a time, you will see, gosh, if I were to invest in MongoDB versus I can invest and get 5.25% in T-bills with zero risk, does it make sense to invest in MongoDB or not? I think many of these unprofitable companies are going through a similar, I would say, dilemma. So that's on MongoDB. CEO Dave Itachera acknowledged the company had a slower than expected start of the year. Weakness in both Atlas consumption growth. So Atlas is their cloud-based what should I say? The cloud-based database. Okay. So, and the new customer wins. Notably, growth in higher value on-premise customer has also slowed significantly. So anyway, on-premise customer doesn't command much from a valuation multiples. That doesn't command much. Premium, your more premium market will assign to your cloud-based delivery, which is based on your consumption growth. But that is now slowing down. The other bigger concern that I had with MongoDB and some similar companies like Confluent is, are these companies one trick pony? MongoDB is again, I don't know exactly, but I think it's on a document database, and its business was once appended by Amazon when they came up with their own document database. Then MongoDB had to change its licensing policy to protect itself. So, but is it one trick pony? Confluent, which is on a data streaming, is it a one-trick pony? I see a lot of retail investors getting excited about Confluent. My bigger concern is, are these single product companies be able to compete with the likes of hyperscalers, which will provide an enterprise customer access to the full suite of products? Unless your product is so great and it's so unique that you would be okay in dealing with multiple vendors, why should you be? So let's look at Confluent, because this is again, I see Confluent on retail investors talking about Confluent, right? Came IPO in maybe out here, 2021, in the peak, went all the way to 91. It's like trading below the price which opened its IPO, $25. Ignore the stock price. Let's look at how it is doing from as a business perspective, right? So it was growing nicely. Now recent year grew at 32%, but margin perspective, negative 61% operating margin. $776 million of revenue and $642 million they have to spend in selling G&A. Minus 470, almost $500 million negative operating income. Go figure. So a lot of these exciting SaaS companies that came IPO and had enjoyed the tailwind because there was no other options for investors to get some decent return. These stocks did well. Where else you will go? But in this case, they are always dependent on kindness of others. The business doesn't generate income. So kindness of other means either you will basically borrow at 0% rate, or you will dilute your shareholders. These are the only two things you can do. What have they done to the shareholders? Where is the shareholders? Yeah, shares change. They've been recent one 7%, 48%, 80%. Huge dilution on shares. Look at in last 3 years, 2022 to 2023, 200% increase in the amount of shares outstanding. So if you were a shareholder in 2020, suddenly your share of the profits of the company is cut down by 1/3. 1/3. Imagine that. Because the company has to generate, there is no other way for them. So again, these are things we need to start looking at as investor, not just the revenue growth, but is the revenue growth is accretive to the margin profile. I would be okay on the revenue growth if you are the only company or you have almost no competition. You have such a unique product that you can capture the whole market, and either you're patented or the tech is so complex, or you have some mode that you can continue to protect. Right? And then, yeah, you can, or you are trying to prove a new industry. You're an initial big player in the industry who is still trying to, like Amazon did. We didn't have any of an e-commerce. So they had to spend in trying to prove the concept and capture the market. Confluent, MongoDB. You go to AWS, you will find multiple variations of similar products, which are based on similar tech. Maybe Confluent is strong, has a better data streaming product than you can buy from other vendors. But data streaming is one part of your overall data strategy, right? So if I'm a CIO, do I want to deal with one vendor because they are best in breed in one, or if I can get 80% of the features of what Confluent is doing, by buying a similar, I think it's maybe Flink or something, Apache Flink, or there are other streaming products or whatever Amazon provides with much lower headache. Will I rather go there? That's a decision that CIOs have to make. Anyway, coming back to MongoDB. Yeah, so that's what these stocks are priced for perfection. Let's look at Salesforce. Salesforce had a slower top line growth. As a quick summary, cloud spending, this is more from a customer's perspective. So what killed Salesforce was the revenue miss, right? CRM. So it was what, 2.6. I think it shaved off what, almost 25% of market cap after earnings. And the reason was the huge it is the first time Salesforce actually missed Wall Street estimate since 2006, almost 18 years. So they've been like consistently beating the estimate or maybe meeting the estimate. Is the first time they had a revenue miss. And the miss was not that great. It's like Salesforce reported 9.13 billion. The estimate was around 9.147 billion. So it's not a huge miss from that perspective, right? It's a $40-50 million miss. It's not a huge miss. But what I think spooked the market was not that they missed by a little bit, but the fact that right now, today, all the enterprise customers are moving the dollars away from other areas into AI areas. Right? How can I, if as a CIO and CFO, I'm gonna have as a CIO, I'm gonna have a discussion with a CFO. You got a limited budget. Whether you spend it on Salesforce or whether you spend it on generative AI models, it's up to you. And now many of these customers, they are trying to figure out how to make, how to bring in AI, and you will hear the CEOs of all the companies, right? Even the ones which are non-tech companies dropping the hints of AI in their earnings call. The question is how you're going to use the AI to either serve your customer better at a lower cost. And if the dollars are moving towards those solutions, then there is a fewer dollars left for someone like Salesforce, etc. Right? For now. So AI is seem to be taking away growth in conventional cloud software market because other cloud software companies, we talked about MongoDB, looking at Confluent results, all pretty bad. I think even, I don't know how Datadog did. There are some of the names that have been very popular, but again, if you don't have an AI play, right now the rest of the market is only asking for what can I do? How can I use AI? So number two, of course, the revenue was missed. It's the first time is Q2 was well below the estimate that Street was expecting. Q2 guidance is 9.2 billions. Operating margin, earlier they given a guidance of operating margin of 20.4%. Now they updated it to 19.9%, which is a surprise. One thing that Street like the least is a surprise. They don't want to be surprised. But in this case, Salesforce surprised at almost all levels, surprised on the revenue level, surprised on the margin level, and Street didn't like it. They also reported they're going to buy back $2.1 billion of shares because they got a $2.75 billion of free cash flow. So still, it's not a dead company. I mean, still generating $2.75 billion of free cash flow. But let me just look at where that free cash flow is coming from. Because you will see many companies talking about generating free cash flow. The bigger question is this free cash flow sponsored by, so how much is free cash flow? This should be 2. Oh, it's more, it's $6 billion. Hold on. So let's go back. That seems to be crazy. Okay, I'll have to look at, but let's go to CRM investor relations. Let's go to the horse's mouth. No, not here. Investor.salesforce.com. Financials. Earnings release. Oh, it's actually 6. So I don't know where did I hear 2.75 billion. So, which is great. Out of 9 billion of sales, like 6 billion of free cash flow, what are they not spending on? $9.13 billion any capex? Not much of a capex, still $3 billion of capex. Anyway, so still it generates, my apologies, this is actually $6+ billion of free cash flow. So it's not a company that given for that, just that today market is only looking for where's the AI. So it's still very healthy business, but it's not growing as fast as it has grown in the past. And again, the management explanation is the enterprise customers are working with tighter budgets. They're reevaluating all the contracts, trying to figure out where do we want to spend money. It's easier to explain to CFO and CEO that I'm gonna spend money on a generative AI. And you drop in the hint of generative AI, you will gain a few $1 billion of market cap. And if you're talking about I want to spend something which is on my back office, like Salesforce, that is actually taking a back seat. And of course, their Einstein, which is their AI play, is not getting that much of a traction. I mean, Mark Benioff is a master in trying to pivot to whatever is a hot. During the days of a big data, Einstein was a big data play. Now, because it's AI, Einstein is an AI play. What I don't like about Salesforce is this huge $48 billion of a goodwill. And this is one area where market is also concerned, and why I am still not an investor in Salesforce is, is it only growing via acquisitions? If you go back and look at the Salesforce over the past few years, they acquired Slack for $27 billion or something like that. I don't remember the exact figure, somewhere around that. They acquired MuleSoft, they acquired Tableau. All they're doing a lot of acquisitions. And now $48 billion is what they paid over and above the book value, which, not the exactly right measure, but still there are $48 billion of goodwill sitting on their balance sheet. So the question is, can they continue? Can they grow organically or not? Is the other concern I have, because Mark Benioff is an acquirer. Will they be able to stitch all these acquisitions? So far, he has been, but I don't know
Excuse
how
me.
it will continue in future.
20 years ago, that's what they said about Cisco too.
Yeah, and Cisco stock hasn't done much in 20 years, even though the revenue has increased a lot. So I'm not writing Salesforce. You can't write Mark Benioff off, right? I think the bigger question is, will it continue to be the huge growth story that it has been for last 2 decades? Probably not, and which is okay. Right? Which is okay. Companies mature and can still be a huge winner in the markets, like Microsoft. Microsoft had its Lifeline 2.0 through Azure. maybe Salesforce will find something. I mean, they have lots of data from lots different companies. But today, given the standards today is, hey, everyone is looking for AI, and Salesforce doesn't really have a great AI story that they are able to capitalize on, and hence the stock got punished. So if you really have a long-term outlook, you believe in the CEO is still the founder CEO, might look at this as an opportunity to bite at this correction. Not a financial advice, but you need to have that faith in Mark Benioff. The other thing is, no one has been able to work or stand really closely with Mark Benioff, because anyone who tries to get or be little challenging for him, he's shown the door. Yeah, but you can't write Mark off. Nice. He defined the SaaS industry. He's the founder of, if you can call someone as a founder of SaaS, it is Mark. But yeah, so I think it got punished because of the whole AI stuff. But if we are, let's go back and look at maybe annual, not the quarterly, because who knows, could have done something in this quarter which has generated more free cash flow. But let's look at annual basis. $9 billion of free cash flow on $34 billion of so you have like 27% free cash flow margin. That's huge. I mean, that's just amazing for any company. So you can't write out. This company still generates a lot of cash. It may not be able to grow its revenue like 40%. See, look, there's a slowdown in the revenue growth. But that's okay. There are multiple ways they can return the capital to you via share buyback or through the way of a dividend. I don't know. Does it pay a dividend? I think someone is the shareholder, right? Does but in any case, I mean, this weakness could be looked at as an opportunity buy, but the stock may not do, from a company, the growth may not be as it has been over the last 20 years. But if it pivot to AI play, AI becomes big, then who knows? So that's on Salesforce. Pat says, sorry, Asif says, much hyped 17 billion market cap. I think that may have been for MongoDB. That's for MDB.
Can you cover a Snowflake? I don't know why it's another darling going down all the way from $450 to $136.
So
if you get time.
Yes, I'm saying so that's what I said. I mean, it could be an opportunity to pick it up if you really have a long time horizon on this one. You can't write Benioff, write off him. Look at it's trading at. Other thing to look at is even if you look at a price to free cash flow ratio, it's trading at 20, means your yield is 5%. Your yield, current your free cash flow yield is 5% for a business which is now growing at 11% per year. As a big investor, as a pension fund, as an institutional investor, today, why would I want to invest in Salesforce? I can get 5.25% yield on T-bills, zero risk. If Salesforce is growing revenue and let's say they keep the same margin profile at growing at 40%, then I would know that even if I buy it at 5% margin right now, I'll have a much higher margin because it's growing at 20%. It's going to double its its revenue in, if it's growing at, let's say, 30%, it's going to double its revenue in 2.5 years. And that means whatever I pay, my margin is going to be, I'm a 5% yield, is going to be 10% yield in 2 years. But if it is growing out only at 11% with a free cash flow margin of 5%, might give you a reason to think about it. Right? So these are the dynamics which is playing in, right? We cannot ignore the fact that risk-free, you can earn 5% in risk-free today. So every investing decision has to be based on, is it better for me to make 5% risk-free or 7% with huge amount of a risk? That as an investor, that's a question we need to ask ourselves. If interest rates come down, all these companies will suddenly become much more attractive. So if Salesforce start to grow back at 20%, 25%, maybe 5% free cash flow yield will be attractive. May not be at 10% revenue growth. Not so these are the things. So when it was 450, that time probably the yield was near zero. I don't know when it was 450 though. So if it was during the COVID, because the rates were all zero, that's why we see all these software companies at such a huge run up. So yeah, it was like CRM, it was never 450. It was like 300, looks like max to be. But that's like a peak of COVID. 0% yield outside of a stock market. There is almost no, you can't make any money risk-free. So then other way is to look at, okay, can I make money in a stock market? And at this point of a time, the revenue growth projections are all high because all the software all the companies, when everyone is from home, you have to buy all those seats, licenses, whatever. The revenue growth was 30%, right? 24%, 25%. That makes it attractive as an investment. Even if the free cash flow yield is, let's say, 4%, 5%. So there is no one straight answer to say, yeah, buy it right now. It depends on what your need is, what kind of investor you are. If you are happy making 5% without taking any risk, then there is no need to come to stock market today. So that's what. Growing at 11%, 5% free cash flow yield may not be that attractive. Alrighty. Again, that's my thought. I don't own Salesforce, but if I were to own it, looks to be, a proposition. And for the next 5 years, if I want to own it, maybe I could start biting at this price point. All right. Let's talk about T+1. Or is there any other stock or question that you may have?
Snowflake.
Snowflake. I have my own doubt on Snowflake. His lunch is getting eaten by Amazons of the world. So Snowflake came to public with lot of hype. Warren Buffett had invested. I shouldn't say Warren Buffett, but Berkshire Hathaway had invested. Probably came from Todd or Ted, who knows. This is what I still don't like about Snowflake. Right. 4, 5 years, growing at 30%, 35%, 36%, and almost negative 40% operating margin. Something is not working out for them. If they're a new company, maybe, but now they've been in business for long enough. Revenue growth slowed down from 70% to 35% in 2023. They have taken a little bit control on their share dilution. But yeah, for me, I think there are better opportunities in the market than on Snowflake. They are able to show some free cash flow, but the free cash flow could be misleading as well. You may want to look at how they are able to generate a free cash flow. So hold on, we looked at a free cash flow of what? 778 million. Let me see how this free cash flow is being sponsored. And thing that I want to look at is, or not free cash flow, sorry, not balance sheet. Share-based compensation. If they were actually paying their employees and executives in cash, they would not have been able to generate any free cash flow. All the free cash flow is sponsored by share-based compensation, which is now, these are some of the games companies will play because they know market loves free cash flow. So yeah, we'll show you positive free cash flow. But for me as an investor, as a shareholder, you're diluting me by issuing more shares to your employees worth more than $1 billion. And then you're saying, hey, I got a free cash flow. I can buy back or I can return it to you as a dividend, right? So you're basically taking off $1 billion from my one pocket via the way of diluting me. And then you're giving me $700 million in another pocket and say, see, I'm able to return you. I don't know. I don't like that. You're able to generate free cash flow without diluting me. If you're able to generate net free cash flow, not sponsored by stock-based compensation, yeah, I'll love that. But this one, I won't like it. Okay. There is a question on, can you describe Snowflake business at high level? So Snowflake is a company which it provides data analytics capability on cloud. Means you move your data to Snowflake and then they will be able to provide data analytics capability. This is at a 20,000 feet level, right? Now, of course, there are a lot of other tools available in similar area. Right? They are not the only one. There are, and I think again, each of the companies may differentiate themselves by being best in one particular segment. Datadog does data analysis, right? But then they focus more on the data observability, right? Looking at your logs, etc., looking at your performance data from your servers, etc. Snowflake, if I tell you, we're gonna look into your patterns and your sales data, marketing data, whatever, right? But that's what their business is, right? You can have your data uploaded to Snowflake, then use their cloud-based subscription service to run reports or whatever, do your analysis and all this thing. The second business which they started, I don't know when, because I don't track this company, is the kind of a data exchange, right? Now, if you have a data from multiple companies, my data, if let's say I'm a pharma company, my data may be interesting to some hedge fund or so they started the second line of business, which is the ability to I'm sure they'll probably anonymize and do whatever, is to sell the data because the data itself is valuable. So again, I've not looked into this company. I don't know how much is the revenue coming as a part of a whatever they call data market or data exchange, etc. But that's their another line of business, which is the companies can put up their data available, make it available for others, right? And that could be a differentiating factor is that only Salesforce is doing it. I have not heard of other companies doing it, but I don't know how successful that is. But that's what Salesforce is. Now, the bigger question is, if you are just focused on this, will Amazons and, using their Redshifts and other stuff, they have their own tools for data analysis, will eat your lunch. What if majority of the companies have their data on AWS, S3? Right? Now there's a work involved in moving that to your Snowflake to run your analytics and then move it back and all that stuff. So that's basically this is it's Snowflake data analytics company. Maybe I think I spoke a lot. What does it say? Yeah, cloud-based data platform. That's what it does. Now, bigger question is they'll probably use their own AI. They also released their whatever AI agent, etc. is. So that's what Snowflake does. But I don't like the profile. I don't like the profile. So, and even with this, currently, they're expensive. So, not for me.
Which is the best data SaaS stock you are holding?
You look at my top 15 companies, there is no data SaaS in that, right? Is there anyone data SaaS? Nope. I have a concern with these point solutions, right? Which does only one thing. Unless they grow and become a bigger enterprise play, I don't want to know. That's the reason why I didn't invest in Confluent, even though I understand that space. I didn't invest in Confluent. I didn't invest in Snowflake. I don't hold Datadog, even though the Datadog stock has done great. Or in like other data observability, these point solutions could be appended by these big ones, which will say, I didn't invest in Zoom because Zoom had like 300% growth in revenue during COVID, right? But Microsoft threw their teams for free, right? Zoom investment thesis was a little different. They were trying to become a platform. If they would have become a platform, yeah, makes sense. But if you are just one product company, one trick pony, becomes a difficult for me to look at for a long-term perspective. So I don't have any in my portfolio. I would rather go and look at other opportunities. Bobby asked late yesterday evening around 3:30 p.m. Dow and S&P get around more than 100. How can you find out who bought, what caused the update? I have no idea. And I know because and the reason I know this is I had my hedge trades on it. And, before I think because generally I will do whatever I need to do by 12:30 and try to get away. And I think I finished by that time. And then I realized, oh, if I've not done anything, I would have been much better position because the market went up, whatever, 100 points later on that. So I also got victimized by it, but it happens. It's a day. And there will be some other days wherein I'm thankful that I didn't do anything in the last 30 minutes, right? I'm trying to develop a habit in which I don't have to do it when the market is closing, because then you stop thinking rationally because you're in a hurry. So anyway, I don't know what happened. Anything could have happened. It was the end of a month, end of a week. Was it triple witching, quadruple witching? But doesn't matter. Long term doesn't matter.
Vivek, one quick question. When you were teaching cell puts, can I discuss that here or no in the bootcamp class?
No, you can ask the question. Not an issue.
So basically, I did one stock sell put, sell call, and then stock already hit. I did a strike of 27 sell call, and stock already went 29. Is it the best way to cover at the same again cover it, and then if you want to have the stock?
So I hope that you hold the stock. First of all, it's not a naked call.
Yeah, I
Okay.
hold the stock.
Good. All right. I don't want anyone out here to start doing naked calls if you don't know how to manage your risk. So it's a covered call basically, and you sold at a strike price of 27. Stock is at 29. What expiration is it? 21st June?
Next week. So
Oh, next week. Okay. So you are at a high risk of assignment. And now the question is this. Are you okay to let your share go? Look into your tax implications
Mm,
perspective?
no.
No?
So basically, I have like 1,000 stocks. Some I did on 27, some I did on 29, and some I did
Yeah,
on 30.
yeah.
So my cost basis was 30. So I took a risk and I don't want to let it go. So what
Okay.
I did is on 29, I covered it and sold the stock at 29. Is that
Okay.
the same thing?
So that's the same thing that like if you had gotten assigned at 29, so now you cover it means you closed your short call. So basically bought back the call in which you took a loss on the call, but you basically sold the stock and took a profit on that one. The other thing you could have done, and again, I don't know what stock is it. If you think that the stock has temporarily gone high and probably will come back, you could have rolled it out. The stuff that we discussed in the recent boot camp, you could have given more time, roll it out to 19th July. You could have collected a little more premium and would have still don't have to sell the stock and deal with any tax. In your case, anyway, probably not tax issue because your cost was higher. But that's the other thing you could have done is to roll it out to the 19th July, collect.
So you can roll it out also again.
Yeah, anytime. I mean, that's what.
How do you roll it out? You already are in a contract with that stock for like 1 week.
Doesn't matter. You
So
can just roll out your call. So basically, which means close the current one and open another one for the next month for the next one. That's what the rollout means. So like you close your call instead of selling the stock, you could have just held the stock and sold the same 27th covered call for July. You would have gotten some additional premium. So that's another option.
but how can you already have like 100 stock and you already do a sell call? How can you do one more contract for the same contract?
No,
Which
you close that one and open another one. That's what the role is. Close the current one.
close. How do you close it? Like buy to open or like
Uh,
you are talking buy to open or like how do you
No,
close this contract?
so that I don't know what's your trading platform is, but you should be able to just buy. Close means you just buy back what you sold. Buy to
Buy
close.
to open.
Yeah, buy
Okay,
to
buy to close.
close. Buy to
Okay,
close. Yeah.
okay,
Buy
I
to
see.
close, then open another one which is sell to open for 19 July. You got a little more premium. And if the stock has just gone high because of earnings and will come back, then you just collect premium, stock won't get called away, and then reduce your cost base. I mean, I'm in a
So,
similar situation with like some of the like Snap, etc. Okay, I got assigned on Snap, which I took assignment. Then I sold another one for July on 16th. It will come back, reduce the cost basis.
so what does buy to close do instead of buy to open?
You're closing the trade that you had already opened. So it's a closing of an existing trade. Buy to open is you're opening a fresh trade.
Oh, I see.
Okay. All right.
Thank you, sir. Thank you.
No problem. Thanks, Fred, for explanation. Okay, let's talk about JEPI. Then probably, if time permits, we'll come back to T+1. So JEPI is, and first of all, let me ask, any holders of JEPI here? Or anyone interested in holding JEPI? Because earlier there were questions asked on JEPI, what's my thought process on JEPI? And then similarly, you have QL, something related to NASDAQ, similar income generating funds. So JEPI has grabbed a lot of attention from retail investors, and I guess even the maybe institutional alike, I don't know, but a lot of retail investors I see trying to build their dividend income stream. And one of the ways is to, hey, I'm holding JEPI because JEPI gives what 9% dividend yield or something. JEPI's dividend yield is 7%, 6.89%, right? So which is pretty attractive, and 6.89%. So this is almost $34 billion and has grabbed more dollars than any other active ETF in 2023. This is the number one active ETF in 2023 what it does is sell covered calls, basically. Thing that we were just talking about with AJ. So in which when you sell a call, you you get a premium, and that premium is basically your income. That's what it's called, JP Morgan equity premium income, right? But then, looking at mechanics of covered call, if the stock goes higher, the stock could get called away, or maybe you might have a seller remorse, gosh, I shouldn't have done that, right? I could have made more money in just holding the stock. So covered call, it can generate your like bond-like payments, right? You can do it covered call month after month and can generate a percent of income. This is like one of my very basic standard, I would say, active trading. I don't actively buy or sell shares based on where the stock ticker is moved, but I actually reduce my cost basis by selling options against my holding, right? So currently it is giving a dividend yield of almost 6.8%, right? And you could also rise if the stock continues to go higher.
Is this yearly or monthly?
It up to a certain extent. So
The 6 point.
yield is always mentioned in terms of yearly.
I have one more stock that is paying 7% monthly, 8%.
Yeah, so there will be many of such, but then there will be gotchas. There is no free lunch. Why is it popular? Because the stocks are going higher, the bonds are losing. So you can get some dividend, you can get some option premium, you have some upside, because if market continues to go higher, you've got a little stock appreciation built in JEPI, plus you get a covered call income, right? What is attractive feature in JEPI is it takes, of course, it's got a JP Morgan research, access to JP Morgan research. So it's well diversified and it is defensive as well. No sector makes up more than 18% of the portfolio. And no stock is more than 1.5%. Right? Overall, strategy will capture about 60% of the volatility with the aim of delivering steady returns. How do they do this? How are they able to generate? Is to earn premium, they'll write 1 month calls with a strike price that is 2% above the current price level. Right? So just go closer to at the money. So if I really look at, let's say if I am trying to do that on SPY, I'll go 1 month out. Okay, so let's say I'll go 1 month out. With the closest one I can go to is this one. Stock is trading, I'll say 529. 2% out will be, say, $10 out. So 528, I'll go to $10 out, 538. I'm gonna sell this covered call. Okay, so what I'm getting $2.73 by selling this covered call, almost, or let's say at 540. I love whole numbers. $2.13 by selling this covered call, which is equivalent of what percent? 2.15 divided by 528. 0.04%. Right? Multiply by 12, that gives you around 5%. That's how they're able to generate the yield of closer to 6 or 7%. Right? Go up 2%, sell a covered call. That's what they do. But here's where's a stuff which I wasn't aware so far. It only came to know, I think, day before yesterday when I was reading about this. But rather than selling a call option contract in traditional option market, it uses a equity linked notes which mimics the performance of an options portfolio. So this is different. It means someone this is like same stuff as the difference between ETF and ETN, right? Now, they are not dealing it in the traditional options market. What they are doing is having notes which is designed to mimic the options portfolio. Then somebody is responsible for honoring the commitment that they have, given to JEPI. They're committed to JEPI. So number two is the call premium income derived from notes is taxed as a regular income rather than capital gains. I wasn't aware. I mean, I don't hold JEPI in my portfolio, but this was a news to me, that the income from the notes is not considered as your capital gains from a taxation perspective. Right? For this reason, the fund may be better suited to investors who plan to own in a retirement portfolio like 401k, right? You don't have to pay any income tax. But the other now thing is there is a counterparty risk involved because someone is issuing these notes. If it is in options market like you and I do, then the OCC will make sure that the other party, keeps up to its commitment. But in this case, there you also got a counterparty risk from whoever is issuing these notes. So these two things were news to me. So is JEPI for you? Again, it provides an attractive take on a covered call strategy, but you need to think carefully that to have your cake and eat it too strategy, the yields may be comparable to those of bond funds, but not necessarily offer the same downside protection. Remember, if you're holding JEPI, the JEPI stock could go down to zero. I mean, it won't go to zero, but obviously it could decrease. Right? Now, in the bear market, selling a covered call does provide you some protection, but doesn't provide you 100% protection. Right? Stock could go down 40%. You might make 5% or 10% selling covered calls in a year. Stock could go down to 40%, right? So you don't have the full protection, you have the downside. So if you're trying to swap your bond portfolio, in which at the end of a maturity, and I'm assuming you have invested in a good grade bonds, you will get your principal amount. So that is protected. Right? But in this case, your principal amount is not protected. You had invested $100 in JEPI. You make $6 in a premium income, your option premium income, but that $100 principal could become $80 if whatever stocks which is under JEPI decline in value. Okay? At the same time, and this is nothing new, right? If you have done, this is same stuff which is in covered call, right? What are the pros and the cons of covered call? What's the drawback or the risk in the covered call is you make income, but you still hold all the risk of owning a stock in your portfolio. At the same time, you could surrender a big portion of stock market upside because you're selling a covered call at a 2%, means your profit, if the stock continues to go higher, your profit is capped at 2%. So if it continues to, while you made 9% or 8% on your dividend income, you lost out. If stock goes higher 10%, 20%, you are capped out at 2%, right? So those are the things you need to look at. So there was a study which says how often S&P has surged 2% more than in a given month. And discovered that it happened around 38% of the time. So if 38% of the time S&P had gained more than 2%, and if you had sold a covered call, just like JEPI sells a covered call at 2% higher, then means you're not able to participate on the further gains. So these missed gains have translated to a significant lag in performance. Overall, the fund has posted 12.2% average annual return since it started trading in 2020. But S&P has returned 16.1% over the same period. because the markets from 2020, I mean, they've been bullish since now, till now. So then I looked at my own numbers. Okay, so this was the study. So does it have, I mean, it gives you regular income, but then you also run it's like any other dividend stock, right? But with a capped upside. So I looked at JEPI's 30-day SEC yield, which is like almost 7%. Year-to-date capital gain, which is you look at JEPI, what it has done year-to-date, YTD. Come on. Right, let's go to, I think Corsim is sleeping. Let's go to Google Finance, JEPI. Oh, come on. I'll talk to this later. JEPI year-to-date, 3%. So 3% is its year-to-date performance. So your total return, you'll add these two, maybe around 10%, right? And then you got a fee, they charges 0.35 basis points as a fee. So net return will be whatever, 9.65%. Not bad. I'm not dissing JEPI. Well, look at SPY. If you just hold SPY, its yield is 1.25%. Year-to-date gain is 10.21%. Net return is still 11.37%. Over a long period of time, these 1.5% or 1.75% means a lot. Holding for 1 year, 2 year, probably may not notice much of a difference. Holding a longer period of a time, you will start to see these differences. It means, the gap becomes really big. So think about it. Think about these pros and cons before you pick up JEPI. What if the market turns southwards, right? Yeah, probably JEPI will be, better, because then you are reducing your cost basis by getting that yield, right? 6 to 9%. Whereas S&P yield so far is only 1.24, dividend is only 1.2%, right? So you can reduce your cost basis much faster if the market turns southwards. So based on that, think about it. I know a lot of folks have been attracted by this high dividend yield or regular income. Like I can make 7% if I invest $100 in JEPI, right? Great. But you still have the whole risk of going it down. Plus you're tapping your upside. And then you have a tax. It has got a different implication. And then you're paying 35 basis points. Consider all those things, okay, before you invest in JEPI. So that's, I found something new about JEPI. I thought I'll share because it has, JEPI has got fancy of a lot of retail investors. So next time you hear JEPI, what are the things to consider before you before you invest in it. What do letters E, W, Q next to buy and ask price on a stock toss means? Oh gosh, I think these alphabets are the means the best price which is shown in Thinkorswim is from which exchange. I think these are like a code for exchanges. I looked at it long back. I mean, really doesn't matter. From a day-to-day operation, really doesn't matter. But I think that's what it means. I could be wrong. But you may just Google it. Long back when, I started using Thinkorswim, I had a similar question. But I mean, it's more of academic exercise of academic interest than anything else. S&P gives dividend. Yeah, that's what the 30-day SEC yield is, what it tells you how much of dividend yield over the last 30 days. So that is considered in this calculation. So that was on JEPI. So the last one topic remaining is, I guess, T+1, unless there are questions. Or maybe we're hit our 2-hour mark. So maybe we'll tackle T+1 next week. I can hang around for another 5 minutes.
Hey, any questions? One question. Like one basic question, like suppose I'm holding a stock and my cost base is 155 and I want to get rid of that stock. So yeah, even the premiums are very less, like let's say Snowflake. And can I do covered call for like 155 itself 1 month out and let it go?
Yeah, so again, I think we talked about when trying to pick a delta, how do you pick what delta do you want to sell covered call? That depends on your outlook. So if you really, really hate the stock, don't want to see in a portfolio and you're scared that it could go down, then the best thing is just sell the stock.
At the same cost basis, correct?
Oh, no, I mean, sell the stock today in the market. If you think I don't want to own this, I think it's going to go down. If you are bullish, let me say, you are a little less bullish, but you're not turned completely 100% bearish. You want to say, yeah, looks like, let's say, pick Snowflake, right? What else?
It's like I know that stock will go 155 for sure in next 1 or 2 months
No,
because the premium itself for July itself is very high.
what's this? Think or swim as Kong, or paper side at least. So, but if you think that, you know what, a Snowflake chronic trade sideways, or maybe it's not going to go higher, and I am still long-term bullish on it, but I want to reduce my cost basis, then go and sell a covered call. Because at the end of the day, if you're selling a covered call, it is still your overall, you're still bullish on the stock. Right? If you're
I'm not
selling
bearish also.
out of money covered call, you are still bullish on the stock.
Sure. So
So
what does that mean? Is like at least 1 month out I can do cost basis or no?
you can sell, yeah, 1 month or 2 months, up to you. I generally sell around, 45, 50 days out, 30 days out. You can sell it. So that's a covered call, you can do it. I have started to own some of the stocks that I'm like, okay, I don't understand what management is doing right now. So I'll do like at the money covered call. If it gets called away, it's fine. If not, I'm gonna do it again, small part of my portfolio. So if it still, if it doesn't get called away, it becomes a lottery ticket. I'll continue to sell at the money covered call. But if the stocks that I really like it, I want to hold in my portfolio, I'll probably sell covered call at 16 delta, 20 delta. Right? So it depends on what's my outlook for the stock is. In Snowflake, if you think, man, this hasn't performed well, my bullishness on the stock has come down, then yeah, you can sell, at the money or slightly out of a money covered call, sell 1 month out. And if the stock gets called away, great. Like you
So
didn't have to
even
sell
though
the stock
stock
at
goes
130.
down, then also you can do sell call because in last week I learned is that whenever the stock is down, it's better not to sell call. When stock is going up, that time it's better to do sell call.
See, nothing like that. So selling call is you're trying to reduce your cost basis. You're trying to generate a premium and trying to reduce a little bit of your bullishness on the stock. So if you hold up 100 shares of stock, you're selling a covered call at 16 delta, means now your overall delta on that particular stock is 84. So it depends on our outlook. Could the stock go higher? Who knows? If you think that the stock is going to go higher after you sell the covered call, then if you already have that insight or that crystal ball, then don't sell it. I mean, I've seen many stocks gone down from $50 all the way to $10. And at every point of a time, there was a doubt saying, gosh, if from 50 it came to 30, should I sell covered call or not? You don't know. I mean, if you know about the stock more than, if you have some idea where the stock is going to go, then based on that, you can decide.
I see.
So if whatever technicals you use, right? If my technicals tell me that the stock probably is going to reverse, then I'll not sell a covered call. Then I wait for when the stock is little overbought. But in
Yeah.
absence of that, there is no reason why not to sell it. Let me just say, I sell put when the stock is down, sell covered call when the stock goes up. But I'm saying this is, that's the right thing to do. But there is, if you're holding a stock that is just going down and down, you never know whether stock will go up or not. Fred says, I do weekly contract at the money you're just about to get most premium because I'm okay to sell it. Yeah, if you're okay to sell it, that's great. I mean, for me, Stoneco is one. Roblox is another one. Third one on my list is Snap, in which I'm like, okay, if these stocks get called away, I'll be fine. So I'm becoming a little more aggressive in selling covered call on this stock. Maybe dollar out of money or at the money. So, and if not, they don't get called away. Okay, I reduce the cost basis. What else? Looks like Thinkorswim has quit on me.
Hey, Vivek,
Yeah.
will you be posting the last week's recording
It's already on
on
the
the review again? Oh, is it?
Yes.
Very late?
Yeah, I was a little late on doing that one. Yes, but it is up. I have to do the options bootcamp recording. That I have not done yet. So my idea was today I will sit and, schedule the next bootcamp and send that email and then get the recording out. That's on my plan for today. But
Yeah, I was asking about that.
the option bootcamp or
Bootcamp.
the
Bootcamp.
bootcamp, I've not done it yet. That's I'll do bootcamp hopefully today. I just didn't get time because we got a Friday month end and a weekend. Oh, sorry, and Friday both month end came together, so I was busy on Friday.
Okay. One other question I have. I recently came to know that there is a put call ratio
Yeah.
that kind of gives you leading indicator. Could you speak more about it, either here or in the bootcamp?
We can talk about it. So put call ratio will basically tell you how many puts versus call trades have happened, right? Even Thinkorswim will show you put call ratio. Only if the damn option chains start to come up, I can show. But I don't know. I mean, I've not been able to consistently make a good use of this particular indicator, right? So like whether you will be able to benefit from it. First of all, I don't know if the put call ratio will tell you whether all these puts are being bought or being whether someone buying a put means it bullish or bearish. Because I don't know what else that person holds.
I mean,
So
if it is below 0.75 or 0.7, then generally the sentiments are bullish. And if it is above 1 or close to 1,
yes,
it's bearish. That's what I heard. So you don't believe in that?
not that I can actually make use of it. So put
Okay.
call ratio is one of a fear and greed index. That's why I basically pick up this because put call ratio is one of an input that goes into this. It's got a 7 things that it considers. Where is that? There you go. Put call ratio, right? So more than one. So this is what it says. Okay, it doesn't say you. Yeah, so a ratio above 1 is bearish because there are more puts than calls, and ratio below. Yeah, I think that's the only one. It's above 1, it means it is bearish. So all that actually gets subsumed when you get this fear and greed index. So I don't necessarily look this individually.
Would you share those 7 indicators again?
I mean, this is the, I'll just put this link over to in the chat.
Okay.
This page.
Thank you.
When is the next session bootcamp? It will be this Wednesday, whatever the Wednesday date is. Yeah. So what I've seen that the fear and greed index actually I've been able to make use of that in making my decision, right? If it is in a fear or extreme fear, that's where I'll dial up my bullish is I'll become more bullish on the market. And when it is a greed and extreme greed, I will try to put a lot more hedges and stay away from investing or going long at that point of a time. That's over last 3-4 years. I've been observing it and able to basically control my behavior. And so far, I think that's been helping me in this. But I've not specifically looked at put call ratio. All righty. Anything else you want to talk about?
Yeah, instead of put call ratio, I think VIX and the VIX is the better indicator for.
I don't know. Some says VIX is now broken.
Yeah, because it's manipulation. It will fly 21 after FOMC.
So the other thing is, because a lot of these there's like JEPIs and all that stuff, right? There are a lot of either the income ETF, which is like now almost $34 billion. Then you have those buffer ETFs. So all of these instruments, are selling calls, etc. Could also have an impact on VIX. This is there was another theory around the VIX is now not really, an indicator that it used to be, because now we have these instruments which will, like, JEPI will sell covered call. Doesn't mean that JEPI is selling call, doesn't mean that JEPI is bearish about the market, right? So I don't know, maybe some of the VIX is getting skewed because of this huge amount of calls being sold by these big these ETFs of the funds. But
so Vivek, based on all these indicators from last 5-6 months, we noticed the inflation is not that crazily going down, and somewhere we are reading that Fed might, instead of rate cut, it might do a rate increase next to next week. That can bring the VIX back to again live.
yeah, so if Fed does a rate, first of all, I doubt that Fed is going to do a rate increase. It may not do a rate cut probably for this year, but doing a rate increase is a very big step. So I don't, I have no idea. Fed will do what Fed will do, but I think doing a rate increase is a step which is like too far out. But in case, if Fed, so at the end of the day, VIX will tell how many, basically how many people are what's buying puts. It's calculated based on your ATM put. I think at the money, and not just at the money. I think at the money, then they go back a few deltas out, and then they calculate. So if a lot of folks start to buy puts, right, that will increase VIX. But if you're already hedged or you're keeping money on the sidelines and you don't need to protect a portfolio, I'm talking about you means the institutional investors. And if they don't buy it, then maybe VIX not move. But in case of when there is an uncertainty in the markets, that's where you will see big money trying buying insurance, and that's what spikes the VIX higher.
I see. One last question I have is like, let's take example of Tesla split date announced. After that, Tesla run almost 40%, like 20% when the news came for the split, and then after the split, 20%. So now Nvidia split date is coming next week, next Friday, and
Yeah.
I think stock has run up 10%, and there is a probability that stock might run up another 5-10% next week, and then the same thing happened like Amazon. Amazon splitted and stock crashed 25% after that. Amazon also split it to 125, and then after that, after 1 month, stock went to $100 in next 1 month. So that is the way market is predicting the next 2 weeks. This game plan is set by big hedge funds where they will pump the market crazy, spike to 530, 535, and then crash it back to 500.
Yeah, I don't know. I mean, these conspiracy theories, I don't buy into the fact that some hedge fund can come and manipulate the market. They may be able to manipulate a particular stock, but the US market is huge for any one fund to come and manipulate it, right? So these are just, I don't put any faith in these conspiracies.
No, but US market is right now run by the Nvidia. So if Nvidia goes down, the SPY
Yeah,
index.
so I mean, and I won't be surprised if after the split it goes down. I mean, right now everyone is retail investors are trying to buy it because they're saying, I'm gonna get 10 shares. If I have one, that one will become 10. And like you said, that history tells that initially, even though there is no change in business, it's the same pizza. Instead of cutting into 4 slices, now you're cutting into 8 slices. Right?
No, the same thing happened for Amazon. People think that it will go to
Yeah, so
4.
it's a retail crowd. It's
Yeah.
a retail crowd that is pumping it up, and once that euphoria dies down, things will come to normal. So
Like
I
Amazon
can't
was already a huge business, and people keep thinking since past 4 years that it will go $4,000, and it's not even touched $4,000 in past 5 years.
Yeah. But I can't invest based on now on this particular event, which means no change in business, but just because change in sentiment of retail investors, stock will go higher. Good. I don't want to take that gamble. I own Nvidia. I'm happy to keep it. I'm not owning it just because it's going to do a split. And I'm not going to sell it because, hey, maybe after the split is done, it's going to come back. I mean, split is immaterial to my decision in owning or selling a stock. Well, let me put it that way. That's just me. So,
Ramesh has said something. What does it? Buy a stock?
okay, Fed decision, inflation, employment data, they don't talk about stock market. Yeah, exactly. Fed has nothing to do with this. I mean, they have nothing to do with the stock market. And Fed has shared some yield max ETFs. Yeah, these yield max ETFs are again the same thing. They'll have a synthetic stock position. They'll create a synthetic long position by selling a call, by buying a call and then selling a put, and then they'll sell a covered call at some delta out on it. So, and then they're able to give some dividend. These all yield max, JEPIs and buffer ETFs and what do you call it? 100% protective funds. A lot of these funds we start to see since 2022 because you can actually get some decent premium by selling calls, which wasn't the case because the interest rates are higher. I wonder what happens when the interest rates goes back to, let's say, 2% or 0%. I don't know what will happen to all these funds. So, all right, guys. Good discussions. Thank you for joining today. So we'll have our boot camp on Wednesday. And oh yeah, I want to tell you, next Thursday, no meeting, no Saturday meeting. I won't be here, so no meeting on Saturday next Thursday, and next Saturday, no meeting. And then when I'm back. Yeah, so there will be disruption in our regular schedule.
What about Juneteenth?
So hold
Juneteenth,
on.
long weekend.
So no meeting next week and the week after that. I mean, I'm back on, yeah, but it'll be going to be very tight. Yeah, so no meeting next week and a week after that on Saturdays, and no meeting on 12th Wednesday. Anyway, I'll remove it from Meetup so you know. You don't have to remember it. If it is on Meetup, then we are meeting. If it is not on Meetup, then we are not meeting. Plain and simple. But I want to give you a heads up, no meeting next Saturday and on 15th. So you have better things to do in life. Plan for it on 8th and 15th. All right. Thanks, everyone. I'll talk with you again on 22nd, Saturday of 22nd. And if you're attending, then on a boot camp on 5th. Bye-bye.